Graham's book, The Intelligent Investor, he spends the first couple of chapters discussing the level of the market and whether it was safe for investment. I was wondering what you'd think of the market today.
Well, we don't, Charlie and I don't think about the market, and Ben didn't very much. I think he made a mistake to occasionally try and place a value on it. We look at individual businesses, and we don't think of stocks as little items that wiggle around in the paper and that have charts attached to them. We think of them as parts of businesses, and it is true that currently we have great trouble finding businesses that we both like and where we like the managements, and find them at an attractive price.
Charts do not show the entire picture or the entire health, the overall health of a company. The stock price changes every single second of the day. The PE ratio changes as well in every single minute of the day, together with the price per cash flow or free cash flow per share. Now, all of these things, all of these figures change every single second of the day, but they do not necessarily dictate the overall health of a company, and therefore these figures should be least of our concern. Our concern really is to look at the business as a whole. We have to look at the business model of the company. We have to look at the products and services of the company, and we have to be truly convinced on whether or not the company or the stock of this company is something that we are willing to own a piece of. When we buy a company, we own a piece of the company. I remember last night I was evaluating a certain company. It's a terminal in a western part of Canada, and the terminal is essentially focused on coal. So the majority of coals in Canada are delivered from that terminal, and it is delivered to North America as a whole. Now, I looked at the finances of the company, and it's really good, very strong balance sheet. They have got great assets. The revenue and sales of the company were growing. But looking deeper into the company is predominantly about as being a supplier of coal in North America, in the US and in Canada, really. And majority, or the 90% of the resources of the company comes from Western Canada in BC. And that's about it. And to my mind, how is the company going to scale its operations if its resources are only there? And in the annual report of the company, they did not tackle any plan to operate the company or to expand the company into another terminal, or at least in another part of the country. And to me, if a company or the management does not have any plan to scale the operations and the business of the company, and therefore the growth of the business is limited. But that, I only learned that digging deeper into the company. If I had only taken a look at the financials of the company, then certainly I would have made a conclusion that the company is certainly working and growing. But then if a company does not have any scalability, or even the management does not plan on scaling the company, and therefore I ask myself a question: do I really want to own a piece of this company? And with that valuation last night, I told myself, probably not, and then I move on. So essentially, this, I guess, or I believe, relating that to my own experience, is that the PE ratios and the stock price, they do not tell anything about the company. Really, the business model, the scalability, the finances, and the management of the company, those are the things we should be concerned about. And then we look at the price, whether or not we are willing to pay that stock price in its current price. And if we are, and then we move forward. If we are not, and then we move on. And I guess wait until we reach the margin of safety that we want, and we are willing to pay that or to pay that company for.
I know of no one that has been successful at, and really made a lot of money predicting the actions of the market itself. I know a lot of people who have done well picking businesses and buying them at sensible prices. And that's what we're hoping to do. Charlie?
How could you say it any better?
I guess this second advice is the most popular one, and I tell you, I have watched many people predict the market. There was this guy, a very well popular guy. His name is Harry Dent. He predicted that the market will crash and burn in the second quarter of the year 2021, and it did not happen. And he is not the only one who made such predictions. And according to Warren Buffett, nobody can really predict what will the market do in the next 2 days or in the next 1 month, in the next 1 year. What we can do though is that we can study companies, and if we are convinced and we are willing to own a piece of that company, then that is a better prospect than predicting the market. We cannot time the market, but the sensible thing to do is to study companies and then buy when we are convinced that we want to own such a company.
Whenever a bright person, really bright person, goes broke that has a lot of money, it's because of leverage. You basically can't. It'd be almost impossible to go broke without borrowed money being in the equation. And as you know, at Berkshire, we've never used any real amount of borrowed money. Now, if we used somewhat more, we'd be really rich. But if we'd used a whole lot more, we might have gotten in trouble sometimes. And there's no upside to it. What's 2 percentage points more, in a given year or that year, and run the risk of real failure. But very bright people do it, and they do it consistently, and they will continue to do it. And as long as explosive type instruments are out there, they will gravitate toward them, and particularly people will gravitate toward them who have very little to lose but are operating with other people's money. One of the things, for example, in the LTCM case, and Charlie mentioned it in terms of derivatives, in effect, there were ways found to get around and they were legal, obviously, to get around the margin requirements, because risk arbitrage is a business that...
This third one resonates definitely to me for sure, and that is the effect of debt in a company. Even in an individual, if an individual is too leveraged or too indebted, the pressure surmounts every single day of living. So if a person is too leveraged, it is very hard to truly think of anything else, to invest on anything else, because the person is too focused into paying a certain debt. Now, there are good and bad debt. The good debt is a debt that you take in and you earn from this debt. And the bad debt are the debt that you take in to buy commodities, such as cars, such as watch, such as everything else. And those debt do not earn you anything. And pretty much the same in a company. If a company goes into debt and buys a jet plane to hover management around the globe, then that is certainly a bad debt. But if a company takes in a certain debt to reinvest or to further expand the company, then that is a good debt. But the thing is, what's even better is that the company not having to go into debt to expand its operations. That is an even better managed company. And I have seen or I have read various annual reports wherein the company had to take on debt to pay debt, or the company had to issue shares to pay debt or to expand its operations. And normally, if the company had to do this, then I try to question myself, how is the company being managed? The company does not have enough income from operations, or does not have enough cash, or does not have enough retained earnings, and therefore the need for the company to take on debt. And therefore, if such is the situation, then to me at least, again to my own opinion, I move on and look for another company.
You've already hinted about Coke and Gillette's current valuations and also about their great prospects for the future. But in the past year, both stocks have been down 30 to 50% from their highs. How much farther would they have had to fall before your criteria of margin of safety been satisfied and allowed you to purchase more shares? And two, has the Disney Cap Cities merger gone as well as you would have hoped? And has the future prospects of Disney changed in your opinion?
First question, that's a good question on Coke and Gillette, because obviously we think about the businesses that we're the most familiar with and where we're committed. Neither one of those businesses got to the price that left us happy putting new money in, but we're quite happy, very happy owning those businesses, and we'll be happy owning them for a very long time to come. But it's some evidence of where the market has been and is, that even when they ran into some tougher business conditions than they anticipated, that their stocks did not get down to the prices that caused us to get excited about them. Charlie, you want to comment on that, or the second part?
Well, no, but I do want to remind people that the Dilly Bar is a Dairy Queen product.
Mm-hmm. And they are good, I can tell you that.
I wouldn't want the shareholders to believe that the commercial standards of this operation are faltering. Generally speaking, trying to dance in and out of the companies you really love on a long-term basis has not been a good idea for most investors. We're quite content to sit with our best holdings.
People have tried to do that with Berkshire over the years, and I've had some friends that thought it was getting a little ahead of itself from time to time, and they thought they'd sell and buy it back cheaper. And it's pretty tough to do. You have to make two decisions right. You have to sell it right first, and then you have to buy it right later on, and usually you have to pay some tax in between. If you get into a wonderful business, best thing to do is to stick with it.
When you buy a company, stick with it long term. Do not buy in and out. According to Warren Buffett, when you sell a company, there are two perfect decisions, and you cannot make a mistake on either of these two. The first one is to sell at a high price, and the second one is to buy again in a low price. And in between, in all of these transactions, you have to pay taxes, you have to pay commissions, you have to pay front load, end load of buying all these stocks and fees involved. And only that part, only the fees involved, the commissions and the taxes, already takes so much amount of money from you. And then you have to decide when to buy in. And those two decisions to make are very hard to time. And therefore, the reason that whenever we make a decision to buy a certain stock, the idea is always long-term and not buy in and out of the company. And that is the main reason as well that we have to study the certain company, not only the finances, but the actual operations, products, and services of the company before we buy in. We have to understand the business model of the company. We have to be truly comfortable with how the company is producing its products and services and how it does its own management.
If you were starting out again today in your early 30s, what would you do differently or the same in today's environment to replicate your success? In short, Mr. Buffett, how can I make $30 billion?
Start young. Charlie's always said that the big thing about it is we started building this little snowball on top of a very long hill. So we started at a very early age in rolling the snowball down. And of course, the nature of compound interest is it behaves like a snowball of sticky snow. And the trick is to have a very long hill, which means either starting very young or living to be very old. I would do it exactly the same way if I were doing it in the investment world. I mean, if I were getting out of school today and I had $10,000 to invest, I'd start with the A's. I would start going right through companies, and I probably would focus on smaller companies because I would be working with smaller sums, and there's more chance that something is overlooked in that arena. And as Charlie has said earlier, it won't be like doing that in 1951 when you could leaf through and find all kinds of things that just leapt off the page at you. But that's the only way to do it. I mean, you have to buy businesses. Or little pieces of businesses called stocks, and you have to buy them at attractive prices, and you have to buy them, and you have to buy into good businesses, and that advice will be the same 100 years from now in terms of investing. That's what it's all about, and you can't expect anybody else to do it for you. I mean, people will not tell you about wonderful little investments. It's not the way the investment business is set up. When I first visited Geico in January of 1951, that rest of that year, I subsequently went down to Blythe and Company, and actually to one other firm that was a leading, Geyer and Company, that was a leading analyst in insurance. And I thought I'd discovered this wonderful thing, and I'd see what these great investment houses that specialized in insurance stocks said, and they said I didn't know what I was talking about. It wasn't of any interest to them. You've got to follow your own. You've got to learn what you know and what you don't know, and within the arena of what you know, you have to pursue it very vigorously and act on it when you find it. You can't look around for people to agree with you. You can't look around for people to even know what you're talking about. You have to think for yourself, and if you do, you'll find things. Charlie?
Yeah, the hard part of the process for most people is the first $100,000. If you have a standing start at zero, getting together $100,000 is a long struggle for most people. And I would argue that the people who get there relatively quickly are helped if they're passionate about being rational, very eager and opportunistic, and steadily underspend their income grossly. I think those three factors are very helpful.
There are actually two interesting concepts in this interview. The first one is the idea of compound interest. Start young, because if you start young, then compound interest becomes your best friend. And the second one is, if you found a company that you evaluated and you are convinced that this company is scalable, that this company is healthy financially and management-wise, and the company has got high and durable moat, and nobody around you agrees, you cannot expect people to agree with you. It is your duty to understand what you want. It is your duty to truly convince yourself. It is not your duty to convince anyone else, because you are the person responsible for your own wealth. You are not responsible for another person's thinking and opinion and wealth. You are responsible for your own wealth, and therefore, if you found a certain company that ticks all your boxes, do not spend time convincing any other person otherwise, because that will be a waste of time. At least to Warren Buffett, it says, I read one quote the other day, and the quote says, the honeybees or the bees do not waste their time convincing the flies that honey is better than shit. So I'd like to share with you the same quote, wherein if you are certainly convinced of the business operations, financials, and management of a certain company, you don't waste your time convincing another person, or you do not look for another person to agree with you. You are your own wealth manager, and therefore you are the person who should decide on what you should do with your wealth. Thank you very much indeed. I hope that you enjoyed this video, and I hope that you gained value from my video and my channel as a whole. If you did, please share, like, and subscribe, and I certainly hope to see you on my next video.